Good morning, dear friends, ladies and gentlemen. It gives me great pleasure to welcome you all to this 188th weekly webinar series organized by AABN and to know that I have your support. It made me proud to be your convener and even more hopeful about the future of AABN. I'm honored to have the support of the core committee members and the participants and the inspiration that comes with it. The festivities will provide a wonderful opportunity to reconnect with fellow alumni and entrepreneurs and explore the ways in which AABN continues to shape an exciting environment. As we move forward, inherent in collaboration among individuals of varying backgrounds, perspectives, and expertise, I thank you all for keeping a place for AABN in your lives and for your ongoing support. We have an awesome speaker with fresh perspectives on investing in India, exploring new horizons. Let us extend a very warm welcome to our eminent speaker, CMA Dr. Ramkrishna Kashelkar, to this interactive business networking session. India is already the fastest growing economy in the world, having clocked 5.5% average gross domestic product growth over the past decade. Now, three mega trends, global offshoring, digitalization, and energy transition, are setting the scene for unprecedented economic growth in the country of more than 1.5 billion people. We believe India is set to surpass Japan and Germany to become the world's third largest economy by 2027 and will have the third largest stock market by the end of this decade. Consequently, India is gaining power in the world order, and in our opinion, these idiosyncratic changes imply a once-in-a-generation shift and an opportunity for investors and companies. India's GDP could more than double from 3.5 trillion today to surpass 7.5 trillion by 2031. Its share of global exports could also double over that period, while the Bombay Stock Exchange could deliver 11% annual growth, reaching a market capitalization of $10 trillion in the coming decade. In a world that is currently starved of growth, the opportunity set in India must be on global investors' radar. I have the pleasant duty of welcoming and introducing our guest speaker, CMA, Dr. Ramkrishna Kashelkar, co-founder at Pro F Financial Consultant. Dr. Ramkrishna Kashelkar comes with over 20 years of experience in fields of global macroeconomics, capital market research, equities and investments, financial journalism, and personal finance. He has worked with companies like Capital Markets Publishers, The Economic Times, and Reliance Industries. After completing BCom from the Mukund College of Commerce, Mumbai, Ramakrishna did his MMS Finance from Wellinker's Institute of Management, Matunga, in 2004. He completed his ICWA in 2006. Recently, in 2020, he successfully finished his PhD from the Savitribai Phule Pune University in Financial Management with the research topic, a study of factors influencing the decision-making process of Indian equity fund managers. For this first of its kind research project, he conducted a survey of equity fund managers working in Indian mutual fund industry. He is an ardent follower of global economic developments, the global mega trends, and the investment world. He has a passion for personal finance, the art and science of how an individual should manage one's finances. He, along with his wife, Prajakta, runs a professional finance advisory called Pro F Financial Consultants with 300 plus clients. He likes to speak on topics related to investor awareness. Ramakrishna also holds international title of FIDE Master in chess with an ELO rating of 2284. Before I wind up, let me once again extend a very warm welcome to all and reiterate that the AABN's doors are always open to those who might want to strengthen our work with their suggestions. I also wish to place on record a deep commitment to work tirelessly as a team to carry forward our goals in a constructive, gratifying way. I would like to thank Mr. Rajendra Sapre for his support to connect us to Dr. Ramakrishna and also for the excellent coordination to make this happen. Thank you, and over to you, Dr. Ramakrishna.
Thank you, sir, and thanks a lot for a very warm welcome. And thanks a lot to AABN community and of course Mr. Rajendra Sapre for making this introduction and making this connection possible. And thanks thanks a lot to offer me this opportunity to share a few thoughts. So today we are celebrating Navratris. So praying to the goddess Lakshmi, Durga, Saraswati, we will begin our session about investing in India, exploring new horizons. Why new horizons? Because everywhere you look at, things are in a different horizon altogether, different level altogether. The GDP is going in a growing at a very fast pace, has reached unprecedented, the highest level ever. The stock markets are at a new high. So it's we are in a territory probably nobody had foreseen just a few years back, and things are looking very positive from here on. So I will begin my presentation. So in case there is any disturbance in terms of audio or video, then just do alert me immediately. Otherwise, any queries you can send on chat, that will be appreciated during the session. And otherwise, we can take up queries at the end. So, I'm just putting a few headlines in front of you, which have appeared in newspapers in last couple of weeks or so. Some of these you must have already seen. Some of these may have missed your attention, but it just so Moody's raising India's growth outlook. JP Morgan chief saying $7 trillion possible by 2030. $100 billion of inflows India can expect. In John Chambers, the chairman emeritus of Cisco and chairman of India-US Strategic Partnership Forum, saying India can be nearly 100% larger than China by end of this century. Again, just last month itself, September 19th is what. Or World Bank, IMF, all these major, international financial institutions upgrading India's growth forecasts. All these and multiple, apart from that, of course, many other news, positive news have been flowing around for India. And as Gopiji already mentioned in his like forward, it is essentially in line with what Indian growth prospects are lining up now. And so what we are trying to, and that has also resulted in this kind of a stratospheric jump in the stock market. So this is a BSE Sensex chart. The kind of growth we can see here it's a chart from 1990 till date, and you can see the way it has grown. We will revisit this chart before we sign off today, and we will have another interesting take on this chart, this kind of growth that we have seen in the stock markets. So on our agenda today, what are the things that we are trying to explore today? And we are essentially looking at these entire developments, all these issues from an investor's point of view. Because I come from the personal finance background, so I am basically going to talk to you about how should investors interpret these developments that are happening. So although I know we are a group of business people, entrepreneurs, at the same time we also are investors in our personal life, and that is why we not just ourselves, but apart from that, our immediate friends as well as relatives, we should all be aware about what is happening, why is it happening, and what we should be doing. So why India? We'll just go in a series, basically what has changed, how are the equity markets looking, how are the debt markets looking, what lies ahead, and what we should as investors be doing. So first we'll begin with why India. Again, lots and lots of positive things are known about India, but I'm just trying to package them in a way that you might find interesting, and that might like stick in your mind a little more. India was 10th largest economy in 2014 at around $2 trillion size. And from there till now, India has overtaken 5 major economies: Russia, Italy, Brazil, France, and UK. And now India is like the fifth largest economy, nearly around 3.9, $3.95 trillion is what estimated GDP is today. This year, that is FY25, we are expected to cross $4 trillion and become probably the fourth largest economy, overtake Japan, and then probably next year we will overtake Germany. And again, these $1 trillion figures are always slightly volatile because of the exchange rates. So you know what is happening probably with the Japanese yen, when I mean kind of volatility it is saying. So anyway, just to put it in perspective, India in 1990-91 was a $290 billion economy at this thing, and it was after a very low growth period of 40 years that we had reached $290 billion. It took 60 years for India since independence to reach first complete $1 trillion in economic size, GDP. So 2007-8 was when the milestone was reached. After that, the second trillion came in just 7 years. After that, the third trillion came in another 7 years. Out of that, 2 years were lost to COVID. So ideally, we should say that it came in just 5 years. Fourth trillion is coming this year. It will be achieved this year. So it would have taken just 3 more years from the third trillion, and the fifth trillion would take just 2 more years to come. So by 2027, FY27, Indian economy would have touched $5 trillion size. So it is not just that India is growing. India's growth pace is essentially creating value at a much faster pace than what it was doing earlier. And $1 trillion is essentially is a huge addition to any economy. And that is the kind of addition that India is doing to itself. And of course, that is the kind of growth opportunity India is today. India, as you know, 10 years back was marked as a fragile five economy, lots of problems, economic problems we were in. And from there, we have turned successfully into fastest growing. And it's not fastest growing in last 1 year, 2 year, 5 years. It is fastest growing largest economy for last 10 years, excluding COVID disruption. That is a very long period actually, and that basically shows the maturity of the economy and consistency of the economy. Today, India is growing at more than double the global average growth. So to put things in perspective, China underwent a similar kind of transformation nearly 25 years back. So around 2001 onwards, China started growing very rapidly. But at that time, the global macroeconomic situation was much better. All the countries were much healthier. Economies were much healthier. And the trade was growing at a very rapid pace. Overall, global growth was very strong. So that is something which supported China growth, rapid growth for next like 12 years or 13 years. So from 2001 to 2012-13, consistently China grew at a very rapid pace. At some point in double digits also. India is not lucky, fortunate enough to have that kind of positive or accommodating or generous situation in the global economy today. Global economy is embattled, facing lots of problems. However, India is still doing its best. So even if the 6.5-7% growth rate kind of thing might appear smaller compared to what China used to achieve in, let's say, 2006-7 kind of period, it may appear lower in terms of comparison. However, the context is also different. So that time the trade was growing, everybody was trying to outsource everything to China. China had just joined WTO after lots of this thing and got a lot of favorable terms and conditions there. So that so 6.5 to 7% growth consistently, what India is achieving is still a very solid and a very creditable growth. So at this space, India is already adding something like 350 to 400 billion dollars of GDP to world economy every year. So just to put things in perspective, this is like adding an economy of, let's say, Malaysia or kind of size to the global GDP every year. A mid-sized country economy is getting added to the global economy every year thanks to India. So India has essentially gotten into a virtuous cycle of growth. So what is virtuous cycle? Investments. So growth is leading to investments, investments leading to employment, employment creating income opportunities, income creating demand, demand in creating investments and things like that. So one thing lead to another, everything is adding up to creating a positive growth cycle. So 2030, $7 trillion is something which is very much within sight. Finally, it might miss out by a year or so, but that really doesn't count. I mean, so far as you have reached in that region, whether you have created a $3 trillion of additional GDP or $3.5 trillion of additional GDP is not going to count much. But that the journey is essentially going to be a very, very rewarding journey for everybody. Per capita GDP is expected to reach $4,500. So this is something which is extraordinarily important from consumption patterns point of view. We will discuss that a little later. And India is essentially looking at achieving sustainable growth. So Chinese growth model, for example, I mean, I'm comparing it from time to time. I'm going to compare that, but because many people feel, and to some extent it is right, that India is actually following a path that China has followed maybe 25 years back. So India is following with like a couple of decades delay. So what China is achieved in first 10 years or 15 years of its growth cycle is something which we are probably going to see in next 15 years for India, is how the logic works. So Chinese growth typically went on with a lot of pollution and very, very unsustainable way. When the Beijing Olympics happened, so lots and lots of restrictions they had to put to improve the air quality and things like that. And it has resulted in some kind of a slowdown in terms of the manufacturing processes and the systems that they could sustain. As against that, India is actually trying to achieve a sustainable growth, particularly from renewable energy point of view. And that again will something we will talk a little later. So at macro level, what has changed? So India has been India for what, 75 years now, 75 plus years now. But something has changed. So what exactly has changed in last 10 years or so? First and foremost is government's approach to growth. That is something which is different today, and demographics. So we will explore these two things slightly in details. And at government level, what has changed? First and foremost, government has realized and accepted that growth is not going to be possible without investments. So for any incremental growth for the economy to achieve for India, investments is something which is very, very important, essential. Without investing, you can't grow. And to achieve investments, to make investments possible, you need to have corporate profits. So unless there are going to be profits or a promise of profits, nobody is going to invest. So this is something, a fundamental thought process change that has happened at the very top level and the government level. And if you see all their policy decisions, all their actions, the way contracts are awarded, the projects are launched and things like that, the turnaround times, everything has you can see that this is the kind of fundamental change is driving all these actions. India was not always like this. So India comes with a background that profits are bad, capitalism is evil, corporates are like evil. I mean, these kind of thought processes, socialist background with which India has essentially come up, and those thought processes still prevail at some levels. But uh, so fundamentally, at the central government level, this thought process has now been very crystallized that growth will not be possible unless corporates are able to invest, and they won't invest unless and until they see some incentives in doing so. Second thing is, of course, apart from corporate profit, corporate investments or the private sector investments, the public sector investments also are absolutely essential and important. And so there has been a very, very strong surge in government capex. So last 10 years, the government capex budget was 44 trillion rupees, which was 4 times more than the preceding decades capex budget for the government. This is a very significant kind of a growth and not ever seen in Indian history in the past. So this kind of a focus on spending, and the spending is happening in essentially correcting the infra deficit. So creating roads and in railways and bridges and tunnels and ports and airports and whatnot. You just keep power projects, green power, coal power, nuclear power, transmission, whatnot, anything and everything you see. There are lots and huge amounts of mega government projects are being undertaken, and contracts are being awarded. So that is something which is at one level bringing, boosting, putting government is putting more money into the economy. At the same time, it is incentivizing the downstream private sector also to start capacity building. Regulators have become proactive, and all this is happening while maintaining fiscal prudence. So fiscal prudence is, again, we'll touch upon this thing when we discuss this a little more. The growth essentially is not at the cost of profligacy, not at the cost of increasing debt levels. So that is something which is being managed. So this has happened. This is a major change that has happened at the government level. Regulators have become more proactive for improving investor safety and are also now engaging with the industry much better. So finance industry, we know that in SEBI and RBI and all these people, they started coming out with lots and lots of white papers and discussions. And not everybody will be happy, of course, from the industry that any some of the other changes that take place. Nobody, is happy about regulators taking any steps. Regulatory decisions may being made most of the times, but they are being made, and they are being proactive in doing. Can I request everyone to be on mute, please? There's some. Another change that has happened is that for the first time ever, I have never seen Indian governments working on such long-term goals earlier, at least. But the government has started working on a Vikasit Bharat 2047 kind of an agenda, which is a very, very long-term goal. And it has now cut that into mid-term goals. So there is a continuity in terms of projects that are being launched, that are being conceived, that are being implemented, and there is kind of a visibility building. Okay, once you have reached a certain level, what is the next step going to be? Because you already set a very long-term goal in front of you. some of the, I mean, there is a huge document actually the government has published with regard to what kind of goals they have set and all that. So 6.5 to 7% GDP growth rate, fiscal prudence. This was an interesting thing actually that I found. It's not that India, the manufacturing sector is not growing. This is the analysis that the government did, that because there is a logistics cost is actually on a very high side, that only the coastal regions, they have flourished in terms of manufacturing and exports, because they can access the export sectors. But the interiors always, the northern states have always remained kind of backward. And that is mainly because of the logistics infrastructure not being present. So a lot of expansion is now happening in that, and the target, the government has said that they have now stated target that the logistics cost as a GDP percentage to GDP has to come down, so that the competitiveness of Indian industry vis-a-vis the global peers will actually improve. So these are the kind of thought processes we are seeing now in Indian decision makers. And infrastructure, $1 trillion have already been invested. $1 trillion are to be invested. $1 trillion merchandise goods exports is to be achieved by 2030. 50% energy through renewables. So we'll just go through a few industries and segments, exactly how things have changed in last 5-10 years, and then what lies ahead. We can see $1 trillion have been spent in, so $100 billion a year on an average has been spent in last 10 years, which is huge. That has created, like 2014, we had just 5 cities with metros with around 250 kilometers of the distance. So that has now grown to 20 cities with 1,000 kilometers of running metro, plus 1,000 kilometers of planned expansions in the offing. Railways again, 21,000 kilometers has turned into 63,000 kilometers of electrified railways. Airports number has gone more than doubled. Highways more than doubled, and lots and lots of projects are there in the work in progress. So 500 plus railway stations are being redeveloped. All these things are creating additional facilities, additional capacities for the users, and these are essentially assets getting created, infrastructure getting created. So it will be used over the next many number of years, basically. Right. So when creating of these assets, it creates a lot of demand for things like cement, steel, the basic thing, and also the labor services and all that. Planning and architectures and all these kind of services are in demand when the infrastructure is being created. After that, that infrastructure will serve the community for 50, 25, 30, 50 years to go. Green energy, solar PV capacity is today 25 times what it was around 10 years back. Bioenergy usage has gone up 8x. So like ethanol blending and all these kind of programs which are, so compressed biogas is something which is now coming up in a big way. Already India has set the target that 50% of our energy needs have to be fulfilled by renewable sources, and the roadmap to reach that level of output is already there, and awards, the contracts are being awarded in line with that, essentially. So as I was saying that since we have a very long-term goal and mid-term targets, so there is from an industry's point of view, there is a lot of visibility that what kind of projects are going to be awarded over the next few years' time, so they can anticipate the kind of demand growth more reasonably, and then accordingly feel more incentivized to do investments in capacity expansion in their own projects on their facilities. So this is something which is extremely important. So 590 out of 900 gigawatt installed capacity should be of green. So already in amongst one of the world's leading most attractive countries for renewable energy investments. Half $1 trillion opportunity in green energy itself. Digital transformation is again a story that all of us know about. India is biggest internet data market today. India's data is most affordable, but the best quality. Uh, so in most of the other countries, people use data very sparingly, and we might remember our like days 10 years back or something. We would connect the data for a minute or 2 minutes, check the emails, and then again disconnect data and all that. These kind of behaviors we used to have at that one point in time. Today that is no longer there because it's so affordable. So low cost data has actually spurred a lot of secondary, tertiary benefits to economy and individual, and in terms of lots of innovations that have happened in the downstream basically. So digital payments is a major segment where a huge amount of transformation has already taken place, because that was probably the first space to kind of get disrupted, and that has gotten disrupted big time. Now this QR code based payment system, UPI system, is so ubiquitous that from Bill Gates to everybody. I mean, the people who visit India, they get amazed to see a chai wala and a pan wala basically using QR codes for and using these digital payments in their daily life. So then digital public infrastructure that got created, Aadhaar and Jan Dhan Yojana, and all those things have followed up based on the piggybacking on basically the digital consumption, the digital usage of Indians. That was made possible again because of the affordability. That has streamlined delivery of government services, so it is reaching to the bottom of the pyramid in a much more efficient way today. India's third largest most digitalized economy. It has also, the digital transformation has also spurred a lot of growth in our Indian startup ecosystem. Lots of unicorns have been born, third in the world in terms of unicorns. India was adding one unicorn every 29 days, or every once a month or something. That went up to once every 9 days in 2022. India added more unicorns than any other country in the world. It's already number 3 in the world in terms of number of startups. I think the latest count is something like 140,000 kind of registered startups we have, and the number of startups getting added is amazing. So startup economy is something which benefited out of digital transformation big time. Manufacturing also, of course, government is having this very special focus on manufacturing, trying to increase the share of manufacturing in the total GDP from 17% approximately to 20%, 22% by 2030. So there are some dedicated schemes and missions which have been launched, Make in India, Atmanirbhar Bharat. All these are not just paper level these things, initiatives. Lot of efforts are being taken on ground. Money is put on ground. Basically, investments are being made under this. Production linked incentives, around 2 lakh crores worth of PLIs have been launched across multiple sectors.
People come from marketing, sales, finance, whatnot, right? We all have
our ease of doing business. Government has been very focused on improving that. GST was like one example of doing that. As as it reduced actually the transport times for from goods from reaching one part of the country to another part, and of course it made the entire country a single market. Uh, uh, Massive logistics infrastructure has been created, not just roads but also warehouses and roads. If you'll notice that new roads are being created, highways are being created with dedicated waiting areas for truck drivers and things like that, parking areas, parking bays for truckers particularly. So there is a lot of more thought in terms of how this infrastructure should be more usable from a holistic point of view, different kinds of users of these infrastructure, what are the needs and how they can also be accommodated in the planning processes. Defense is again one major example, defense manufacturing. So two defense corridors have been created, one in UP, one in Tamil Nadu, and 5 indigenization lists have been prepared. 3 lists of subsystems and assemblies have been prepared and published, so people know what is the government's like priority agenda, so they can take up things that okay, we can okay make this particular product in house in India, and with so people can take up projects based on these lists and all that. So also, wherever India is importing equipment and what you say, defense material, there are offset policies are in place where the foreign vendors have to invest 30% of their contract value in India. So necessarily they have to do their sourcing from India, and the new capacity they with partners or whatever they have to create in India, and the production happens in India. There are portals which have been created to encourage indigenization of various products that are necessary. The target India has set is to achieve 50,000 crores of defense exports by 2030. And already, I think last year, FY24, India did some 21,000 crores of defense exports. So most probably we will overshoot it in by a wide margin, probably 27 or something. We should be able to reach this 50,000 crore targets. But we have to understand that we started from a very low base in terms in defense, and have made a rapid growth over last few years. And these kind of stories we can hear in so many other industries, mobile phone exports and all that. You know, the kind of story, that the turnaround story, that it was India was a net importer of mobile phones for a very long period of time, and then now today we are a net exporter and world's, I think, second largest exporter of mobile phones. Electric vehicles, data centers, semiconductors, everywhere you see huge amounts of new investments are being made. Government ministers and people in the high up in the policy making corridors are basically interacting with MSMEs or even mid-size entrepreneurs to very large companies to create capacities, to identify areas where there are lacunae and that need to be filled, those products, how they can be manufactured in India. A very detailed kind of effort is being taken. Power equipment, of course, pharma. There are lots of such things we can. So this is something which has been happening on the public sector capex, government capex side. So that has now started reflecting in the private sector capex. So private sector is always a bit reluctant to invest, and particularly in India, where we have seen policy flip-flops multiple times, and we have seen not a very encouraging attitude from the government towards private sector profitability. So So after a while, it's taken a little while, but private sector capex has now started picking up, and it is picking up in a big way. So capex cycle is now moving into top gear. 6.2 lakh crore in first half of 24 was what was announced. And okay, this was something from a little dated, but uh, this is the latest data that private sector capital expenditure zooms in the second quarter. Uh, that is the quarter ended September. So private sector companies have announced around $4.1 trillion, trillion rupees worth of new projects in this September ending quarter. And added to that, the government's projects worth 1.4 trillion rupees. The total is now 5.5 trillion rupees worth of new projects announcements happened in last quarter, just single quarter itself. So this is the kind of investments that are getting into Indian economy, and this is just the beginning. I mean, the private sector has been very shy, I would say, or reluctant to really start making any commitments. Of course, it has had some kind of a background in terms of high indebtedness at some point in time because of whatever reasons. We don't have to really go into too much in details of that. And so bad balance sheets at one point in time was responsible for deferring capex. But now the balance sheets are repaired. The banking system is very robust. NPAs have been removed out of the system. The banks are ready to lend. Corporates are having cleaner balance sheets they are able to borrow more. And there are now contracts and awards and growth prospects in front of them that can justify their investments. And so all these things are essentially happening together. And so just it's like the virtuous growth cycle that I mentioned about. The new SBI chairman just recently, this is the 25th September story. So he's just mentioned that there's a 4 lakh crore of credit demand pipeline from India Inc. at on the doorstep of SBI. So the kind of projects people have, the loan applications that have come to SBI are in the range of 4 lakh crores. So this essentially shows the kind of investments that are yet to happen or are after whatever has happened so far. This is something now is the cycle which is now turning the next round basically. So on all these things, when this is happening all this while, one of the things that I also mentioned about was fiscal prudence. So India is essentially maintaining the government level very strong and improving macroeconomic parameters. So in 2014, our inflation levels were in the range of 10%. So almost entire, excuse me, sorry. So 2014, a couple of 3-4 years prior to that, inflation was in double digit for India. Today, it has come down to 3.5%, which is 5-year low and actually below the pre-COVID level. So amongst many other countries, in that sense, India successfully bringing the inflation down to pre-COVID levels. It's something which is very, very interesting. Not many countries have been able to do that. Current account deficit has gone down substantially. So current account deficit is basically is something which is necessary to maintain your so to import the forex that you need to import whatever your necessities is being generated from your exports. So there is no on the current account the deficit is very, very minimal, 1.1% of GDP. At its worst, it used to be I think 2012-13, I think it has gone down to 4% of GDP or something, which was very huge, had very disastrous circumstances, led to very disastrous circumstances at that point in time. So again, fiscal deficit is being being brought down successively. So 5.9% in 24 to 4.9% in 25 to 4.5% in 26 is the roadmap which has been set, and so far consistently, except for, of course, these again, the fiscal deficit went um, higher mainly because of 2 years of bad this COVID disruptions. Otherwise, prior to COVID, also India was on a fiscal what you say contraction path. So what is essential to understand is this again. Going back to the same point which I made again made earlier, is that government is achieving growth while maintaining fiscal prudence and really not pushing too much cash into the system. Many of the this is you have to contrast this with the growth, let us say, in the countries like US growth is essentially being led by in today's context. Today US is growing at maybe 3% or something, US economy, but it is essentially being led by a huge amount of debt creation every year. So, and there is lots and lots of discussions about whether that kind of a debt is sustainable for US economy to go ahead and all that. And with the elections around the corner, both sides of the election candidates are basically just not worried about, not talking about this problem at all. Not they don't have anything to say or do about it. So things might get interesting pretty soon in terms of US. We don't know, but anyway, in case of India, being prudent is fiscally prudent is very essential, and it has long term benefits. Uh, so. Important thing is net borrowings for FY25 in rupees crore terms. So it's going to be lesser than what the government actually borrowed last year. This is a very significant thing, that India is growing, Indian government's budget is growing, but because the fiscal deficit is being brought down, the need to borrow has gone down. So last year, Indian government had a net borrowing of something like 11.5 or 11.6 lakh crores, if I'm correct. I think that now for this year, the budget is FY25. The net borrowing budget is something like 11.4 or 11.5. So slightly lower than what it was last year. And this is something which the finance minister, she has explicitly said that this is a trend that we want to maintain. There are 2-3 things that happens when this. Just spend a minute here. When the country is growing and the government is spending a lot of money, and when the government needs to borrow more and do the lending, what happens is that typically the private sector gets crowded out in the credit system. So whatever money is available in the system, government picks it up, and borrowing becomes very costly for domestic corporates typically. So since now in India it is not happening something like that, Indian corporates are able to access cheaper credit. So these are all indirect benefits that flow from from discipline being maintained and all. But many times people miss out that such secondary, tertiary kind of effect. But it's very interesting to note, because they have very long-term repercussions. So debt to GDP, again, India is one of the lowest across the world, 83% something right now. Again, there is a roadmap to bring it down to 82%, 81% over the next 2-3 years as a percentage to GDP. So India again is one of the very few countries in the world which is having debt to GDP ratio lesser than pre-COVID levels. Everywhere across the board, you see all countries, they passed through that COVID phase. They printed lots and lots of more money. They borrowed heavily. The governments are heavily indebted, and basically when you are borrowing happens, basically you are drawing on your future incomes today, using up your future incomes today. So at some point in time, you have to make those promises, make up for those promises. So more the debt, it's going to hurt those economies in the longer run. All those things are reflected. All these developments we are seeing here are now reflecting in the more short-term things, which are like forex and INR. INR is something which is like keeps on fluctuating in a daily and this thing on a basis, minute-to-minute basis. So it's a very a live kind of an indicator of India, the economic strength. So just yesterday, I think this news got published that all-time high level of forex reserves, $705 billion almost. That is the latest number. Then there was a prediction by somebody, I saw that around. So by end of this fiscal, probably India would be at like $750 billion of forex reserves. So on one hand, the current account deficit is shrinking. On the other hand, the foreign investments are continuing to happen in a robust way. And of course, there are so the forex kitty is essentially building up. What exactly it has meant is that rupee has remained very stable in last 2 years. So excuse me. So around 2000 in 2022, at around similar September October level, rupee was trading at something like 82.80 level. And today, after 2 years, it is at 84 point whatever 03, 04. So this is the kind of small range in which rupee has traded. So excuse me. Yeah, sorry. In this time, essentially, if you compare any other major currency, you will see that the volatility is on a significantly on a larger scale. Indian rupee has been very stable, and from an investor's point of view, what matters them is basically stability, because that gives a lot of uh, uh, predictability. It adds to predictability. So whether it is whatever is happening, if it is clear and predictable, that is something which investors love typically. So this is on the economy part, whatever has happened and or is happening right now. So we move to something, the second part of it, what has changed in terms of demographics. So we are known about this demographic dividend and everything we have been speaking. We must have each one of you must have heard of it. This thing. So just putting it in this graph basically. So this is graph again made from the UN population projections, which is something they keep on doing every year, and so the red line you can see is that of China, and you can see from around 1980 onwards how rapidly it has gone down. The average age, or sorry, this is the dependency ratio chart. So dependency ratio essentially means how many the ratio between working age population and non-working age population. So it dropped dramatically from 60 levels to below 40 levels by 2010. And that is the time when Chinese growth actually peaked. So in around 2010, China overtook Japan to become world's second largest economy. And so 2027 is the time when India would be at its lowest point in terms of dependency ratio, probably. or nearing the lowest point in the dependency ratio. And probably that will be the time when India will surpass Japan again. I mean, so Japan will be the main country to overtake that point in time and become India the world's number 3. Okay, Japan has now become number 4, so Germany should be India should overtake Germany to become world number 3. So anyway, Japan and Germany are like a couple of $100 billion differential in their GDPs. So any fluctuation in Japanese yen creates the ranking changes overnight. Sorry. So, and yeah, so the point to note is that when the demographics were very, very favorable between 2000 and 2010, that was the time when Chinese GDP grew at an average of 10.5% per annum. So this is the point which I was actually referring to earlier, that India is actually kind of replicating what China was doing at, let's say, 25 years back. And however, things were their growth at 10.5% and our at 7%, 6.5 to 7%. It's still kind of a equivalent we can consider, because that time there was lots of tailwinds. Today we are facing lots of headwinds in global economy. So anyway, this demographics is something which is going to be favorable for India going ahead. China has already actually had it's expected to, I mean, is feared to have hit a wall and essentially, or it's going off a cliff in terms of demographics because of its very stringent one-child policy. So Chinese population, in fact, by the end of this century, it's expected to be like half of India's population, kind of thing. So that's going to be a very, very drastic change in Chinese population over a period of time. And of course, that has a very, very negative impact on the economy. In last 10 years, again, a lot of changes, a lot of progress has happened in India. Poverty has gone down substantially. Again, UN, IMF, World Bank, all of them have held India in terms of pulling lots and lots. I think 415 million people have been pulled out of abject poverty. So 41 crore kind of people who were in the category of the benchmark is, I think, $1.9 per day kind of income levels. From there, 41 crore people have been moved out of that kind of poverty. And this is the multidimensional poverty. This is the level which is, I think, $2.9 a day or something. So slightly bigger. So it's still 11% people are there under that. By 2030, it's expected to go down to like 2% of the Indian population would be at that kind of a poverty level. Income inequality is going down. So this is like multiple research have been conducted, and they are basically indicating that last 10 years have brought down income inequality. So the income growth at the fag end of the income pyramid has been much faster compared to at the top of the pyramid. GDP per capita has reached 2,730. Again, you might be aware that in the economic progression of any country, crossing $2,500 in per capita GDP is always considered as a inflection point, because after that, at that point in time, typically the population starts moving from subsistence level to their consumption patterns basically start differing. People want to upgrade their lifestyles and things like that, and that leads to a lot of consumption boom. So India is already gone into that zone, and so incremental growth is again. So investment-led growth is going to be accompanied by, and already to some extent it is already accompanied incrementally going ahead, will be led by India's consumption growth as well. So India took 75 years to reach a per capita level of 2,730, which is today. It will take just 5 years more to add another $2,000 of per capita GDP to this number. So this is the kind of growth that we were going to see. So the natural progression of people who are not having any mode of transport, going for a bicycle, by people who are having a bicycle, going for a two-wheeler, a person with a two-wheeler going for a second-hand car. So this kind of a natural progression is something which we will see on a greater scale going ahead. And naturally, it has an impact across the entire economy and demand as well as the investments. So these are the typical income pyramid that we had historically, with a very large base at the bottom. Bottom of the pyramid used to be a very large, traditionally very large poor section of the people we had. But this base has started shrinking, and lower middle and upper middle class, the sections of the pyramid are somewhere where we can see the bulging that is happening. And this is the trend that is going to continue. The base is going to shrink even further going ahead. And middle income groups and low and higher middle income, higher upper middle segments of income, we are going to see large addition. The people shifting from bottom of the pyramid to the higher up in the hierarchy. So this is something which is going to happen, which has already started becoming visible. This is going to accentuate going ahead. Again, it has an impact on the consumption patterns. People going for more branded products, people going for more packaged food, people eating out more, people going for more vacations, people going out more entertainment, consuming more entertainment and movies and things like that. So lots and lots of discretionary spending starts happening once you breach the threshold of around $2,500 annual income levels per head, per capita. So that is something which India has already started seeing. India's, if you see the latest like air passenger numbers are the highest ever. India's four-wheeler numbers, the four-wheeler sales numbers for last year have been the highest ever. Two-wheeler sales, again, highest ever. Electric two-wheelers, the demand is growing very rapidly. Again, you can link it back to like GST collection numbers, because GST collection again reflects the economic activity or the demand consumption activity in the economy. So there again the robustness is seen. So again, this is again referring to that virtuous growth cycle. So on all these backgrounds, I mean, we have taken a deep dive into the economic angle of India's story. Now, as an investor, we also need to take a look at exactly what is happening in equity markets and what dynamics are being driven. So, equity market typically is as I tried to put it like this, it's a table with four legs: valuation, sentiments, momentum, and liquidity. So these are the four things that drive equity markets typically. If any of these, any one of these legs is not working well, then it will not be able to stand properly. It will start wobbling. So we will just touch upon each one of them one by one. Valuations. So the current question that anybody would have in their mind is, markets, are they overvalued? So much of run up has happened already. 40%. Nifty 50 itself has gone up like kind of 40% in last 1 year. So are the markets overvalued? That's a quick and a common question basically what anybody would have. But this is just a chart of like last 24 years of Nifty PE ratio, price to earnings ratio, And you will see that today the P ratio at around 24 is higher than the average, which is 21. The long-term average is 21, but it is hardly so. You can't call it as a overvalued kind of thing, or something which you have to be alarmed about. Sorry. There have been multiple periods in the past when the price to earnings ratio has been on a significantly on a higher side. Still, I mean, it's definitely not low valuation. I will not definitely say that, but it's a rich valuation, but not in some kind of a bubble zone. So not in itself indicating that some kind of a correction is imminent. Of course, this is nifty P ratio. There are other, I mean, the smaller, mid-size and small-size companies. Of course, they have run up much faster, much larger extent, and there the valuations are probably stretched on a much higher level. So. This is a Buffet, Warren Buffett's favorite kind of ratio that he checks at in terms of market cap to GDP, and compared to, let's say, countries like US or Japan or Canada, India still appears within a very reasonable range. I mean, it's on a higher side. Compared to India's historical levels, it's on a higher side for sure. Compared to countries like China and Germany or UK, which are like facing lots of economic problems right now. Compared to that, again, India is on a higher side, definitely. But on a standalone basis, compared to let's say countries like US and Japan and all that, India still is not in a excessive zone. And why is India's, this was an interesting thing that although the markets have run up, but then why has not the P ratio gone up? So the P ratio has not gone up because the profit growth has kept pace with the stock price movements. So this is data which is sourced from Motilal Oswal's one of their research reports. You can clearly see that on the left side chart basically shows that Nifty 500 companies' net profits have grown at a 34.5% CAGR for last 5 years. This is absolutely staggering. I don't think there was any period in India's history in the past that 5-year period we could see such kind of a CAGR in terms of corporate profits. Second chart, this exhibit 2, essentially shows that corporate profit to GDP ratio so corporate profits as a percentage to GDP, if that ratio is to be calculated. So it had reached a peak of 5.2% in FY28, probably 2008, and that consistently went down to 2.1% in 2020. Of course, it was the COVID phase, and after that it has shot up substantially. And last 5 years, you can see it has gone back to 4.8%, which is like 15-year high. So this is something. So the growth in share market is essentially led by underlying profit growth of India Inc. Some companies would have, of course, be more, and for some companies it would be less. But on a macro level, that is how it is. Sorry. On this chart, basically, you see how the GDP, India's GDP grew for last 15-20 years, and in that GDP growth period, how the India Inc.'s profits grew. So the first phase, basically up to 2008, India GDP grew at 14.5% CAGR, but profits grew at 30% plus CAGR. After that, the GDP grew at 12.5% CAGR, but corporate profits grew at just 4.5% CAGR, significantly underperforming the GDP growth. But last 5 years, the GDP growth is at 10% plus CAGR, but the profit growth is at, as we saw, 34.5% CAGR. So this change has again happened, and again you can link back to my the comment which I made previously, in that the government's mindset has changed, and this is something again reflective of that. So second leg, about liquidity. So valuations, we saw liquidity is something government markets are right now flooded with cash, and we'll explore this point in a little bit. SIP's numbers, you can see this. This is the SIP chart from April 2016 to August 2024. And you can see that up to December 2020, or maybe, yeah, it was quite a sluggish trend in terms of monthly SIP investments. So first, after first, what you say, COVID, the 2020, this thing of COVID, first impact of COVID, and from 2021 onwards, there's been very dramatic change in terms of investor behavior. This is something that the kind of growth that we have seen in these last 4 years is simply amazing. It's simply unprecedented. So there is, because of this kind of huge cash flows, now 23,500 crores of cash is getting dumped into mutual fund industry every month. And this is something which the fund managers know, that this kind of SIP, if I don't deploy this 23,500 crores today, next month I'm going to have another 23,500 crores, or probably even more than that, to take care of. So there is a growing cash pile in mutual fund industry. So the last count was like 1.8 plus lakh crores of cash was lying uninvested in mutual fund. Because again, there are some fund managers who want to, I mean, some cash is always kept as a liquid balance, but at the same time, people want to take a wait for some kind of a correction to deploy cash and all that. So and this is why where we are seeing that any sale off in the market by FIIs, or because of any kind of external news, is quickly getting absorbed by domestic investors. So what happened on 2nd of October was a market holiday. 3rd of October, the markets opened on a negative note because of the developments, Iran-Israel developments on 1st and 2nd of October. So you see that another 2-3 days max, it will take, maybe tomorrow, day after tomorrow, markets will again be back on the similar levels as before. Because there is a lot of fear of missing out. If I don't buy in this fall right now, if it's a 5% correction, if I don't buy this stock right now, which is 5% down, then probably I will not find this price again. So, and in terms of the other two legs, basically sentiment and momentum, I don't need to really comment on that. Momentum just continues unabated, without any hindrance, without any hiccups, without any hurdles. And sentiment is extraordinarily positive. Never before seen kind of positive. Huge amount of new investors entering the markets on a every month basis, and average age profile of the investors is going down. So they are more enthused. They are more ready to take risk. So momentum and sentiments remain positive for the market. So valuations are not in the bubble zone. They are reached. but they are supported by financials. They're supported by earnings growth of the corporates, and liquidity is ample. So these are the four legs appear very robust as of now for the equity markets. Nothing appears to be very out of place. So in the markets, exactly what are the things that have changed in these last 3, 4, 5 years? Retail participation has gone up tremendously. Even today, not even today, I should say, today 40 lakh demats are getting opened every month. The total number of demat accounts in India has reached 17.1 crores already. I think this is the for the month of September count is. And so you can imagine the kind of retail participation. People are common people. Basically they are shifting their funds out of fixed deposits and into the stock markets, either by way of mutual funds or by way of direct equity. And because of digital communication and digital platforms, firstly, it has become very easy to do, and secondly, a lot of investor education is taking place already. People already know lots and lots about stock market than what situation used to exist, let's say around 12 years or 13 years back, when we started doing investment awareness series. Investors' risk profile is changing dramatically. So the kind of risk profile the investor would had, let's say 2014, 15, and what it is today, 10 years back and today, it's totally different. People are very well aware of the risk of equity markets, and they want to come forward to take risk profiles, to take risk and create wealth. So this has become possible because first is the higher disposable incomes. People are seeing more savings, more investable surpluses being created. Second thing is that the investor age profiles are going down, and they are digitally enabled, so they can invest on their own also quickly, and at the same time they can acquire knowledge on their own also very quickly. At the same time, it's not just the investors which are changing. The investment product or the investment world itself is changing. So lots and lots of investment product innovations are being made by the industry. Costs are being brought down, so that again there is a semi pressure for bringing down the cost. But apart from that, because the scale is increasing, automatically bringing down the costs is something which is feasible for the and possible for the. And of course, there is a lot of competition in the product market also. So in mutual fund itself, we have like 42 mutual funds competing for whatever 66 lakh crores of AUM size so far. In PMS, if you go, more than 500 PMSs are there, and that kind of the competition is very wide, basically in the product market as well. So costs are coming down, which is good for the investors. And another development, of course, is that the FIIs, the way they used to dominate Indian markets at some point in time in the past, is now a total completely history. So recently there was a research which was conducted by somebody, and it was I forgot the research, Angel or somebody had conducted that thing, and that what is the percentage of if the holding of FIIs in terms of Indian market. So Indian market capitalization is in the range of $5.5 trillion, $5.6 trillion maybe, and 5.6 out of that 5.5, $5.6 trillion of market capitalization, approximately 17% is owned by FIIs. And as against that, the Indian investors, the Indian institutional investors are actually now holding higher than FIIs. So 17 point something percent is held by FIIs, 18 point something percent is held by DIIs, And plus there is 9% or 10%, which is direct investments by individual investors. So Indian investors are actually now, apart from promoters, of course, promoters are not counted in this calculation, but retail investors are now enjoying a large chunk of this wealth creation that has happened. So that again has an impact on personal consumption patterns of households. These are the things which will be seen, which will be felt in a subsequent time periods, which are yet to we are yet to see those changes happening on ground in terms of their consumption pattern changes. Because till the time the money remains invested, you probably don't have it in your pocket to spend, but you at some point in time book your profits and use it for consumption at some level or the other. So that is something which we will see going ahead. So investor risk profile, I mentioned that investor risk profiles are changing. So here is an interesting, what you say, comparison with the pyramid that we all know, Maslow's hierarchy of needs, as we would have heard about it multiple times in the past. So we can relate investor risk profiles also with this pyramid. So at the bottom of the pyramid, there are people who have very, very basic needs with regard to investment. They just need a capital safety and very, very predictable kind of returns. So essentially what we don't call it as investments, but we call them as savings. So savings products, so fixed deposit kind of products is what are going to meet their needs at level 5. So level 4 is something which people think a little beyond, going beyond savings, and they are looking for something which is investment, which is they're ready to make a larger ticket size commitments than what they were doing at level 5. So they might go for investing in something like real estate or some things like that. And many times people use insurance as way of investments. Level 3 is somebody who is ready to so level 4, they basically think that, okay, touching and feeling investments or real estate is something which they feel a little more comfortable with. Level 3 people are now comfortable with a little abstract understanding of wealth and the way stock market and everything behaves. So they go for mutual funds and stocks, and they would typically go for large cap stocks, coffee can investing kind of methodologies that they follow, stable portfolios, long-term wealth creation around 12%, 15% CAGR, buy and hold strategies, not really tinkering too much into the. So these are the kind of things we see on the third level of risk profiles. When investors move up from this level to level 2, then that is the level where people, it's like shifting from a Maruti 800 into a kind of a maybe BMW. So that is where the esteem factor starts playing out. So that is where you need more sophisticated investment products. So personalized, customized, something which will which will stand apart from the masses, very niche kind of products. So here the portfolio management services kind of things start making sense, a lot of sense. And depending on the risk aptitude of each individual. And then at the very top, you have like self-actualization level. So here people are ready to make large commitments also for very, very distinct kind of asset profiles. And they don't want to remain restricted with just one kind of like equity kind of a portfolio. They will want to invest in assets generating incomes directly. So infrastructure, real estate, they want to invest in that and directly at a very large level, very large scale. So alternate investment funds is something which becomes a vehicle for them. So we are seeing that there is a very strong shift in terms of investor risk profiles that is happening. So investors are, we saw that mutual fund investments are going up rapidly, but at the same time, PMS investments are not like lagging or have suffered or anything like that. PMS investments have also gone up very rapidly, significantly, 35 lakh crores. So last reading, which I think I had checked, was in April 24, and that was around 30 lakh crores. So within a quarter or so, another 5 lakh crores got added to of AUM has got added to PMS industry. So this is the way the industry is growing right now. AIF, again, alternate investment funds, AUM has grown four times. It is slightly a niche industry as of now with just 11 lakh crores of AUMs, but not too small anymore. So, and AIF has a like category 3 AIF has got, they invest in the equity markets itself. So they have differentiated product strategies for equity market itself. So they are also market linked in that sense. So category 2 will go into typically infrastructure and real estate, that kind of investment. So they may not come to the equity markets, but category 3 AIFs are into equity markets itself. So so we are seeing this change which is happening in terms of investor profiles. So debt markets again is a very important part of all this entire discussion, because at the bottom or at the base of the equity pyramid essentially lies the debt market, the fixed income market, because as you know, the equity returns are essentially compared to what the fixed income, the risk-free returns are available, and whether the risk is justified in terms of the returns that equity offers. So, in any economy, the kind of fixed income returns, the government security returns that are there, GSEC returns, that is like the benchmark for measuring effectiveness of the equity investments or equity markets, basically. So here we see, we just have like, I just have quickly drawn this thing, US 10-year bond yields, which were in, and from December, has gone through multiple cycles, but the last cycle now, the interest rates have actually started going down. We saw 0.5% rate cut being taken recently last month. And so this is going to be expected to be followed by UK and Europe and other countries. Japan, the new prime minister who was just sworn in, he has said that he doesn't want to increase the interest rates any further. So they are going to remain as it is, 0.25%, I think it is. And India is again likely to this month itself, the monetary policy committee meeting is going to happen. So expected to reduce interest rates in India as well. So Indian 10-year bond yields are also on a downward trend right now. So all over the world, essentially the capital markets have gone through one cycle of getting the capital getting costly when the interest rates went up. And now we are probably seeing a turnaround of this cycle when the capital is going to become less costly. So historically and logically, you can see that whenever the money becomes cheap money becomes available, that gets into the risky assets like equity, and equity is where you always get the investments will flow into equities essentially. So as the interest rates start going down, you can see a commensurate improvement in the equity markets going ahead. So considering all these discussions, if we were to ask what is the biggest risk in the market today, so my answer is that the biggest risk in market is not being adequately invested. thinking about ki this war might happen, this thing will happen, some policy will change, something might happen, the share price is too high, something like that, and not being able to deploy your committed capital for the purpose of investments is the biggest risk, because markets will probably surprise you on the upper side than on the lower side. Waiting for correction is, as you know, waiting for correction has lost more money historically than in the correction itself. So biggest risk today in the markets is not that the markets are going to fall or crash or something like that. Some of the other volatility will keep on playing out at any point in time. Markets are definitely not uh, uh, like a capital safety program that you will, everything will be promised, so that you can't expect. But of course, some corrections here and there you have to break, brush it off and face it with a smile. Basically, that's not going to be a big deal at all. So here I'm just going to play a small video just to put things in perspective in terms of how market volatility or market risks are to be one should pursue. Just Gopiji, in case it's not audible, then just alert me immediately. I think it should be audible. We tested it before we started.
Yeah.
But it's
Risk comes always unannounced and from the sources you don't expect, right? So risk is something you can't avoid, you can prepare for. Now let me give you one little differentiated perspective on risk, that historically if you see all of us are worried about deep correction risk, right? I don't think anybody worried about कि कल Nifty 22,000 हो गया 23,000 हो गया तो क्या होगा. People are worried कि can Nifty go down to 15,000, 16,000, are there structural problem, is it similar to 2008? That's a big risk everybody wants to understand. So let me say, historically big risks have come to India only because of 5 sources. There is no sixth. And what is the situation of those each of them today? Number one source has always been current account deficit. We import more, export less. Whenever our current account deficit goes out of hand, our country starts sneezing. 1991 happened, same thing. 2012, we became part of fragile 5. Our currency depreciated 20%, economy went for toss. Our current account deficit has gone to 4.5%. Right? Today, because of manufacturing and all those things, our current account deficit has come to less than 1%. And in next 5-7 years, we are going towards become current account surplus country. Meaning we don't need to rely on, for our consumption on export, foreign capital. So that current account weakness, fragility has been repaired or is being repaired. That's not a big risk. Second is fiscal deficit. Whenever our fiscal deficit goes out of hand, government borrows, inflation goes out of time, inflation goes up, interest rate goes up, and many situations happened in the past, right? Today, we all know that our fiscal deficit is one of the best managed in the world. And this time around in the budget, finance minister reiterated that we will continue to, and with the tax buoyancy and everything else, we know that, no earlier, ये होता था कि divestment का target कम है तो market ऊपर नीचे हो जाता था because fiscal deficit will go up, right? How much borrowing will go. Today, no more the case. Nobody even think about it, right? Number 3, our banking system. Whenever our banking system went for toss, whether again 2001, 2008, 2013, 14, NPS went out of the hand, we had always a big implication on the economy. Today, our banking system is best in the world, well capitalized, well provided, and ready to grow, digitized. I can tell you with a lot of sincerity, there is no banking system in the world which is like this. So that risk is again not there. Fourth, inflation. Whenever inflation went out of the hand, again, our economy, corporate profits again will have a challenge, right? Today, inflationary, we are managing best in the world. Just think about it. What if we did not import Russian oil? Our economy would have gone for toss. We do not realize, there's a saying that we don't realize the value of accidents avoided. We know when it has happened. So inflation is one of the best managed in the world. And fifth, our debt to GDP, corporate debt to GDP. Our debt to GDP at 75% is the lowest in the world, or one of the lowest in the world. And we are the only country whose debt to GDP post-global financial crisis has come down. Our corporate debt to GDP is lowest. Our corporates are not levered. In fact, one more thing, that today, earlier when market would fall, it will get accelerated by what? Margin funding selling. Even that does not happen because of, thanks to SEBI, they have made the margin at 50% and only approved stock. And total margin funding is hardly anything. So because of that also market does not fall. That's the reason if you see, these are the 5 structural problems which always led to market, deep market falls, corrections are structurally repaired. And once we have this perspective, and that's the reason you don't see deep falls in the market. Market falls and then goes away. I am not saying that correction won't come. If tomorrow Six Sigma event happens, like pandemic happens, nobody can, things can happen, right? My point is that structural weaknesses are not there, tactical weaknesses will come, and this government has, in my opinion, done a great job and is doing a great job in terms of repairing structural weakness. So if we keep this perspective of the risk in mind, I think it will give all of us a good handle.
Yeah. So he was Mr. Vikas Khemani of Carnelia Hedge Fund. So we could hear his views, and he basically very clearly put forth the point. Sorry. Yeah. So just I'll quickly lead to our final few slides about in the equity markets. As an investor, essentially, patience is something which always is going to be the most important ingredient. And market corrections, you have to understand whenever they come, if they come, whether they are small, big, shallow, deep, those kind of things, they are not aberrations. These are market features. So historical perspective, if we see that 10% to 15% correction every year is something which happens without fail every year. So markets are bound to be volatile. However, you have to, the major question that, as Mr. Khemani was also saying, and also which I had alluded to, basically, that are we worried about 2-3% corrections, or are we worried about like 10-15% kind of crash? So if we are not, ideally we should not be worried about 2-3% corrections, because as I said, that's like a kind of market feature that is something bound to happen. And if we have to fear that, then you have no really role to play in the equity investments at all. You should be in the fixed income side. So as an equity investor, you have to be ready to face 2-3-4% like minor corrections. Whether market crash is coming or not is something we have to be little careful about. But with the markets, essentially you have to understand that volatility is something which is going to accompany it. And so this is a very important saying, that if you can't handle me at my worst, then you sure as hell don't deserve me at my best. So this is what the markets are, something which tell us, and we as an investor has to understand this. Again, coming back to the first chart that we began with, this is the beautiful journey of BSE Sensex, and what I've done is I've marked some of those iconic crashes in the market's journey. And from Harshad Mehta scam to Asian currency crisis of 97-98, tech bubble burst of 2000, Ketan Parekh scam of 2001, 2002, UTI going bust, UTI Unit 64 going bust, then subprime crisis of 8-9, sovereign debt crisis and taper tantrums of 12-13, Brexit in 15-16. And you can see, when you are looking back at all those things today, from the mountain peak of 85,000, all those things appear extremely small, extremely minute. So Harshad Mehta scam, you will not be able to make out, okay, it was at so smallest level, looking back from 81,000, 84,000 now, kind of. So 85,000 was just a week back or so in September. And now, because of some correction, we are now at 81,000 or something at Sensex level. So those are like minor differences. So just to come to a conclusion, basically India remains a very, very strong fundamental story, and there are multiple legs of growth which are there. When one gets tired, there is another pair basically which takes up the lead, and things like that. Sector rotation keeps on happening. The story just continues to roll on and on. Valuations remain rich, no doubt, but they are far away from bubble zone. So no, one should not really take this thing to their mind that, okay, we are, because the market has run up, that basically means we are in a bubble zone. No, valuations are not in the bubble zone at all. So growth in the markets is sufficiently supported by earnings growth. Liquidity is strong and continues to grow. There is no, what you say, end game in sight, or nobody is able to envision what exactly is going to happen with this kind of cash flows, cash getting flown into equity markets the way it is happening today. So nobody had envisioned this kind of liquidity to grow in India. And remember, India is having what, maybe 5 crore people investing in equity markets so far. I don't know even if that is the correct number. Maybe there are 17 crore kind of demat accounts which are created. Of course, people have multiple demat accounts. So 5, 6, 7 crore max number of people would be invested, and there is like 140 crore people we are talking of in. So there is still a huge amount of what you say, equity cult or culture yet to build inside India. And even the what you say, people who are just moving into middle class, lower middle income segments, if they start SIPs of like 1,000 rupees, 2,000 rupees a month for their futures safety, you can imagine that boond boond se banta sagar sort of huge amount of liquidity will get created that will get invested in equity markets. Small corrections are always possible, so forget about that. That is not to be worried about. But India today is like a once in a lifetime, once in a generation, as Gopiji rightly put. But once in a lifetime is what I would I have put it like that. Opportunity is to create generational wealth. So here people should not be worried about making wealth for myself, my family or something, myself, my wife, uh, things like that. But for my children, for my grandchildren, that is the kind of wealth can be created in next 10 years, and that is the kind of opportunity India is presenting today. So how can we help you? So just to talk about briefly, I'll introduce ourselves. Pro Financial Consultants. We are like 13-year-old organization advising investors on how to invest, where not to invest, what not to do, and things like that. We can be your trusted partner in growth. We do lots of research, and not only the economic, macroeconomic, but at the same time in terms of products also. So we choose products basically similar kind of feature products, but the lowest cost products and things like that. So this is something which we uh, keep doing, hand-holding and helping decision making, supporting, providing perspectives in terms of how to think about a problem and how to reach a proper conclusion. And in terms of risk management, because that is extremely important for your portfolios. So these are the multiple ways we can support you in case anybody has any requirements in this regard. Definitely after the Q&A session, we can connect individually and take it up further. So thank you. These are our contact details. Please do note down, and Gopi sir, we can open up for a Q&A now. Thank you so much.
Thank you very much, Ramakrishna. Excellent session. A lot of takeaways from it. And we'll just keep the floor open for question and answers. Participants, may please unmute and ask your questions, please.
Hello, Gopi sir. Can I?
Yeah, please go on, Damani.
Yeah. First of all, many thanks to such a fantastic presentation. Maybe since we are from engineering background, these financial things are totally new for us. And I'm absolutely happy with that slide number 42 and 43. Acha, so I have two questions actually. First one, there has been a lot of controversy regarding the calculation of GDP, especially when Subramaniam Swamy, sorry for taking the name, but the thing is, he is supposed to be one of the expert in the side of finance and Harvard professor. There has been a lot of disagreement with the claims made by the present government by him. We want to know what is the actual truth. That is question number one. Question number two, what is the minimum investment you would be handling for individuals like us? These are the two questions.
Okay. The first question I will take up first. I mean, see, all these calculations, GDP, all these macroeconomic numbers, take from inflation, from GDP calculations. These are all very complicated, what you say, calculations, and they are based on certain methodologies, which are so which differ from institution to institution. So India's GDP, if you see, going by World Bank and going by IMF projections, they will differ. You'll see that they're giving two different numbers. They will again differ from what RBI is giving or what our Indian government is giving. That doesn't necessarily mean there is any dichotomy, or they don't what you say so there is any kind of a disagreement or clash in these numbers. It just simply means that their methodologies differ in some way from each other. Certain factors that they consider, certain
So sorry for the interruption. So that means what you mean to say is the methodologies might differ and hence the figures might differ.
Correct.
So now the question is actually the relativity must remain the same.
Exactly.
Correct. No, once
exactly.
the relativity remains the same, we can appreciate not the numbers but the concept. But
correct.
Correct. No. So
absolutely. Continue.
Why that is not being highlighted. Rather, there has been a lot of halagulla and then belittling, blaming. I feel it's not right actually. So please.
Yes. Yeah. So so far as the consistency is maintained, so then that problem should not happen. So as you rightly said, however, yes, there is a in economics, typically, it so happens that there are always contrasting views about how anything can be measured or anything should be measured. So as simple as like inflation, rate of inflation, to anything to do with, let's say, poverty measurement and things like that. Everywhere the methodology gets questioned, and you will always have these differences of opinion seen. There are some which are very much out there in the public, like the person you mentioned. He's very vocal, and he's very much out there in the public with whatever opinions he has, of course, and the most respected person. I would not, I will say that. But so governments has a system. They have the statistics department that goes through all these numbers. So Central Statistics Organization, CSO, is there, which has the duty of calculating all these things. And there is a what you say, periodically they do revise certain things. So the way, for example, inflation needs to be calculated. So there can be a change in the components, or change in the weightage of things that are taken into calculation for this thing. So there is another like debate which is right now going on, whether to exclude food products from rate of inflation when they are deciding the interest rates changes and things like that. So when you are calculating inflation, core inflation, basis that should so Raghuram Rajan has had a different opinion, saying no, that should not be done, and things like that. So these are public debates, and these kind of debates will keep on happening. So that is not something that unless you are a very unless you are an academician, then academically, yes, you should. It's a rigorous thing that you should really follow. But apart from that, as a general investor, I don't think you should pay too much attention to that. Follow any one thing where you can get a consistent backdated kind of data and series that you can work with essentially. And the second question, basically with regard to minimum investments and all that, sir, I mean, essentially we have no investment limits as such in terms of things. So the model that we follow essentially is that we speak with the investors, try to understand their what you say financial goals, their asset liability situation, their inflow outflow situation, their insurances.
Sorry, sir. Actually, the question is very direct. Why? Because this Bajaj people came and this Kotak Securities came. Like that, when the people keep on approaching us, especially after we get retired from government service, actually they know a chunk of your money will be available with you. They all are telling that minimum our investment is if you plan to invest 15 lakhs, come to us. If you plan to invest 20 lakhs, come to us. Like that, they put some minimum requirement. Is there anything like that with you?
No. We don't follow that. In fact, just to I mean, put a context to this, we started doing this after understanding that I myself, being with a finance background all throughout, and my work experience being in the capital market industry, in spite of that, my own personal finance decisions, essentially, or the investment decisions were extremely conservative, extremely traditional. So I had like 2 LIC policies and some pension plan, which was charging me a lot of cost. Basically, I mean, it was a very expensive plan. But it was like, okay, some friend would come and Arey, this is a very good plan, please take. So I would sign, and I signed and just took it. Insurance policies, like somebody came to our family agent kind of situation people have. So that person came, okay, now you have started working, so now you have to have a LIC policy. Chalo, this is a good plan, everybody's buying, you also buy. I had no really what to say. So when I looked back at those things, then I realized that if I was making such kind of mistakes, putting money into unproductive ways, basically, rather than making it work for me, it was working for somebody else. So rather than so to correct that situation, then when I did all these exercise for myself, cleaned up all my portfolio, old portfolio, everything, just sold out whatever 50%, 60% discount losses booked and exited. So that point in time, I realized I should offer this kind of service, this kind of advisory to people at the very middle income level, because that is the kind of people who actually need to manage their finances the most stringently. So the most efficient efforts, the most efficient deployment has to happen at the middle class level rather than the HNIs and super HNIs, because they actually get this kind of advice from wealth managers, with advisors, like all these institutional guys. They keep on tapping them. So we have always worked with this thing that even if you want to start with bare minimum investment, you begin as early as possible and stay invested for as long as possible. And we try to work with you to ensure that your investments will last as many years longer as possible, so that they will create a greater wealth for yourself, for your family. So
thank you. Thanks a lot. You should thank Mr. Gopi for introducing a customer to you. Thank you. Nice.
Sure, sir. Definitely. There are some questions on the chat. I'll just.
No, we have Mr. Ravindranath. Sir Ravindranath, sir, can you offer your views, sir?
I just complimented him because I have been already been doing this for quite some time, and I think the way he has gone about it was excellent and very, very authentic, I would say. And also he said very clearly what towards the end. I mean, the last question, what he's answered was absolutely beautiful. He's given his own story of how he's been sort of taken in by some of these investors. I mean, actually, my only point is, I mean, to many people who may approach you later, Mr. Ramkrishna, is that actually you have to look from the investor's point of view. A lot of people in these financial analysts and all that, and also they, or even the banks for that matter, many of them have these systems. Their main aim is actually how to get into their own profit motive and how to get their business multifold and so on, and not so much into the real requirement. I think he has answered that question very well in the last part, just now, what he's answered Mr. Dhavamani question. So that was excellent. And I think I do agree with all your metrics, which has been used by many people and then trying to, so there are a lot of political connotations come into these numbers, though he has not said that. Everybody has got their own agenda, and then there is a push the agenda by saying, even I mean, I can say openly in this forum, even a very intelligent man like Raghuram Rajan, one of the best guys around, but sometimes he deviates and he gets into off the track, just because he's got some inclinations towards some political inclinations, which is, I think, our type of investments and the kind of people who we have in this group, they don't want to get into all that, nor we are interested in the high level GDP. But the success story, what you have presented, is absolutely true. I mean, it's there for us to see that. I mean, whether something moved from one end to the other end in the last 10 years, what has grown in almost all the dimensions you have covered, though it's taken a long time. I also started for a short time to be around, but then I continued between watching your lovely presentation. And then your more than presentation, the slides, I think, is the way you have said everything is the compliments to you, Mr. Ramkrishna. Excellent. All the best.
Can I?
Thank you, sir.
Gopi, can I have a word?
Sure, sir. Sure.
Mr. Ramakrishnan, nice presentation. Really appreciate. I was lucky. My father started way back in the 60s investing in stocks.
Wow.
I really enjoy my late father. That is, I mean, I thank him every day morning. Sir, I am actually in a very, Gopi knows, a lot of distress because one of my classmates, single father, he's now in ICU, and we as friends, we do not know how to help him. Sir, I have a small request. Why don't you start addressing school and college students to form a small association or a society, whatever it is, whatever you call it, a group, and start investing. Even imagine in 82, we were a class of 63 when he passed out. If we had all invested 100 rupees a month, today the corpus, now see, there are two issues to it. One is probably people have money, but they may not have people to help. Suppose this is a group that associates in investing, and it has its own, team leaders and things like that. They can be of support to the family financially. The group can support the needy. I think your presentation must be done at school level, college level, since I also believe the best is yet to come, and India is poised for great growth. If you can take your time, it will be voluntarily. Obviously, even people with gray hairs do not, as you said, only 5% are investing. It is going to be difficult, but I think on a mission mode, if you can start college students, they can probably invest 1,000 rupees every month as a group. They can collect themselves 30, 40 years hence. It will be a big help to their own classmates in distress who are suffering from things. Why don't you start a movement like that, sir?
That's a very nice. Thanks.
I regret.
Very nice.
We all came from the upper. We went to good school. We had, family support. Everything was there, but we really do not know how to help. I mean, who will stay with this guy? Can we put a full-time nurse? Who to tap? And what will happen when we do this regular investment will also keep the group together. For example, this AABN, this is the 188th seminar. This collective effort is keeping us all 10:30 morning. My family knows that I'll be attending this seminar. So there will be a purpose also. These school or college people can, of course, we have get-togethers and all that. But this will be a meaningful get together and purposeful also for the family. And you know, maybe the last person alive may take a jackpot, or they can have a return down goal of or they can have a return goal of, you know, who should do, they can help, they can form bylaws, you know, probably, you know, it can only support family members, not girlfriends, you know, you can have rules like that. I'm just telling, I'm just trying to say, I'm appealing because I'm going through a lot of distress right now, because I do not know how to take care of my friend from school days. We are all like, we are running, I mean, with all our experience and all our background, we are running like headless chicken actually, because we don't know who will really take care. You know, I thought this will be a great help. Your presentation, I think on a mission mode, you should go to more colleges and schools. Thank you, sir.
Definitely, sir. That's a nice suggestion. Great idea.
Yeah, I am
Sorry,
Thank you.
sir, I just missed one point actually. Sorry for interrupting once again. Sir, recently introduced taxation on that short-term investment matter. You just did not touch actually. Can you just tell, is it going to be a negative point on this investment matter?
So the short-term and long-term tax rates have been revised upwards. So short-term capital gain was 15%, that has become 20%, and long-term capital gain was 10%, that has been made 12.5%. So that is something which is negative for all investment returns going ahead. So short term is basically less than 12 months of holding for equity, and anything more than 12 months of holding is like, it goes into long term, where now you have to. So right now, so tax is basically part of the incremental income that you are sharing with the government. So when you are investing, let's say 1,000 rupees, and that 1,000 rupee becomes 2,000 rupees, then that whatever incremental 1,000 is there, out of that incremental 1,000, you have to share, what's say, 1,250 rupees with the government.
So
Again,
actually, government is not encouraging this type of investment. It is trying to take more.
See, government, see, you have to also take into account that government also has to look at from the point of view of raising funds for the welfare, or for the well-being of the bottom of the pyramid people in the have-nots kind of situation. Of course, the freebies and the dole-outs and these kind of things is something which is bad, which creates actually a very negative behavioral outcome from those section of the people. But that is where the politically we have been like fixed into that area as of now. We are not really saying that, okay, you do 10% and then I will give you 90%. That kind of situation is not there. You're basically people are habituated to take 100% free, everything free kind of thing. So that is not the ideal situation for sure. However, so coming to this point, that taxation, so capital gain taxes is something, it's a very contentious issue globally. Even in the US, if you will see, there is a lot of debate going on with regard to rich becoming richer, because they have got so much of equity investments, and equity investment just keep on going up. And so this Musk and all, Elon Musk and all that, I mean, they're like the richest individual in the world and all that. So what is wealth coming from? So there was a proposal on charging tax on increase in share prices also, not just whether you are encashing it or not. So there was some kind of weird thinking which was going on in that sense as well. So charging something, a tax for something which is a value creation, wealth creation, or something which gives you more money in hand, is logical. So tax essentially on this capital gains is logical. So income, if you earn, you are basically investing your time, your knowledge, your capabilities into something. You earn, let's say 1 lakh rupees, you end up spending 1/3 of it as tax. And there is a, let's say 1 lakh rupee investment you had made, which has become 2 lakh rupees, and 1 lakh rupee gain you have made. On that 1 lakh, you just end up paying 12.5% of that. So not 1/3 of that. So in fact, compared to your physical efforts and income that you earn out of your physical efforts, compared to that, investment incomes are still charged at a lower rate of taxation. I'm not in any way in favor of like justifying the higher tax rates or something like that, not justifying it in any way, but I'm just trying to put across a perspective that and this is something which like death and taxes is something like nobody can avoid. So it's something which we have to face at some point in time. It's like that. So taxation, if we can increase, India has a big problem with regard to tax base. India has like not what 3-4 crore people who pay taxes, not more than that, direct tax payment. So as against a country like US, which has like 1/4 India's population, India has 1.4 billion kind of population. US has like 350 million kind of population. Still, the taxpayers, number of taxpayers in the US are like 3 times more than, or maybe 4 times more than the number of taxpayers we have in India. So this is a huge dichotomy. There is, again, this has got historical baggage of lots of problems, like agriculture remaining totally out of purview of taxation and all that. There is a lot of still prevalence of cash transactions in the Indian economy. So lots of problems are there. I'm not denying that, but fact remains that India's tax buoyance, even tax to GDP ratio, simple things like that. Out of India's GDP, what is the percentage of tax that India is able to collect? So India is able to collect only maybe 11% or something that's out of the GDP as tax, as against European economies, which are like between 20% to 25, 27%, or US for that matter. So naturally, it becomes the governments have much more amount to spend or at their disposal, basically, because of lots and lots of all the economic activities happening under formal sector. So there, if you go to Europe and all these things, you will find informal sector as such kind of non-existent. In India, 70%, 80% of economic activity happens in informal sector. They don't pay any taxes, but then they keep the cost of living very low. That is the second, that is the other side of the coin, basically, that India has a purchasing power parity which is significantly better than in the US. So I was just talking to somebody, in 25,000 rupees, an average individual in India can spend a month without decently, not of course with the luxury, but he can feed that person. The person can feed himself for like twice a day at least, completely, without having to bother too much. But if you give that equivalent amount in dollars to somebody in the US, that person will not be able to survive even for 2 days. So that is the kind of differential, the cost of living being so low in India, mainly because there is a lot of informal sector that still exists. So how to bridge all these gaps and really bring up people into the formal economy without really disturbing too much the cost of living, because it's a fragile thing. I mean, there is so much of society which depends on things becoming available at cheap cost. You bring everything under GST and you try to formalize everything too much, then you are basically making a lot of problems, creating problems for the a section of the society. So lots of it has to be a small for what you say, a steady process, and to some extent we have done some progress on that, and it has to be matched with the income levels, and a lot of this thing you will probably see happening in next 5 years, when actual India, what you say, average GDP, per capita GDP levels go up to like $4,000+ levels. that is the time when you will naturally see a lot of formalization taking place. People, because they know that the opportunity of catering to to a larger population is higher, so they want to enter into a formal kind of a business environment, the service providers and product makers. So you will see that those things happening organically to some extent in next 5 years.
This is Balasubramanian.
Yes, sir.
Yes, sir.
Yes, sir.
I have some 2-3 points to be discussed.
Hmm.
I have been watching this NSE market for the last 10-15 years.
Hmm.
So people, the pouring the money when the market is at peak.
Hmm.
That's what I see. The bank deposits are grown by 70% last year, whereas the mutual fund AUM is grown by 152%.
Hmm.
When the market is get corrected, say like in COVID period, people are withdrawing the money and moving away. So this should not be that. It should be the opposite way. When the market is in the low, they have to come into invest into the equity market.
Correct.
The second thing is the newspapers and digital media. They are making some negative impact whenever there is a correction. See, the Nifty has grown by 7,000 points the last 1 year, and it is corrected by 1,000 points. And Sensex have grown by 20,000 points in the last 1 year, and it is corrected by 3,000 points. And the headlines will be, the news headlines will be, the investor lost 2 lakh crore. That's what they say.
Yeah.
That's only a reduction of small money in their profits. So that's a reduction of small money in their huge profits. They are lost money. They're not lost actually. So this is the point number 2. And 3, there is another big marker what you have missed out in your presentation is derivative segments. The volume in derivative has grown exponentially. The equity volume is around 200 trillion last financial year. And the volume in the derivative segment is 80,000 trillion, nearly 400 times more. So the people has to be, aware. There is an opportunity available in, derivative segments also. But actually, it is not happening. 93 out of 100 traders in F&O are losing their money. That's what the says. But on SEBI also, on the other hand, they want to discourage the people. They are trying to increase the margin in the derivative segment. But what that should not do that. They should not do that. But actually, they have to train people, make more aware out of what is happening there. So that's my view. That's how to do that. So I want to have your view on these 3 items.
So first, I will talk about the media thing that you mentioned. So first, see, again, all these 3 questions are essentially interlinked. So my answer will actually cater to all 3. So first and foremost, you have to understand that at a very basic level, when a share gets traded, let's say XYZ company, any Reliance Industries share gets traded at 3,000 rupees. The fact that it got traded basically means that there was a buyer and there was a seller at that point in time. So buyer was thinking that 3,000 rupees is a good price to own that share. And seller was thinking that 3,000 rupees is too much of a price, I should sell. It's overvalued. So dichotomy of views is essential for a market to exist. It is not, so just to understand this, there has to be multiple views prevalent in the market, only then the market itself can exist. So if in a smaller share, you can always see that if there are only buyers, the share price is on a upper circuit. There is no trade that happens. So for any trade to happen, dichotomy of views or multiplicity of views is a basic necessity of this thing. So in a market, what happens typically is there are people with multifold of views who are congregated at any point in time. So there are people, there's a category called as scalpers. Scalpers, they buy at 100 rupees and are trying to sell at 101. They will do this transaction 100 times a day to earn their living. They're expert in that. Can you imagine? I don't know any of us has ever thought of or has ever seen or ever met such kind of people. But there are these kind of people who are working on a thin margin, multiple trades consistently to earn, make a living or this thing. Or scalpers, or they are also called jobbers. So then there are people who come with a like buy today, sell tomorrow, BTSD, what BD, whatever, BTST, whatever, something like that. These kind of philosophies people work with, and then there are people who are investors who buy for like, I'm buying this business, like Warren Buffett kind of investor. I'm buying this business for 5 years, 10 years perspective. If tomorrow the stock market is not going to be there, I'm still going to be happy as an investor in this business. So there are people from very extreme spectrum of thought processes who come together in market, and that is the beauty of the market. Essentially, that is how the market really exists. It becomes possible to have multiple kinds of things happening. So coming to the second question, essentially is that media by its own nature caters to a very small segment of this market, which are essentially traders and speculators, people for whom, and it's a large section of audience, of course, that they want to cater to, people for whom day-to-day market prices going up and down, that matters most, is the kind of audience for which media, and typically the electronic media, I mean the news channels, they cater to. Newspapers are slightly for traders, plus some section of the newspapers, the business newspapers, you'll see that they are talking of long terms, they're talking of government, some taxation, some interviewing some secretary, under secretary of commerce department, or something like that. So they are giving you perspective, some legal perspective, some law, whatever changes, corporate law, what is happening, company secretary law, something happening. They will give you perspective of all those things in a newspaper, because newspaper is something which you will read at a leisure. But again, the first page and first couple of pages will always be dominated by what happened in the market yesterday, what is happening, likely outlook tomorrow, somebody coming and saying, okay, tomorrow this is going to happen, things like that. So essentially, you need to understand, when you look at a news article, you need to try to think 1 second that what is the target audience for this write-up. Am I the target audience? Am I, again, and then the third question, of course, you have to ask is basically, how am I approaching the market? So we as an advisory essentially try to create investors. So investors are not bothered about ki aaj market mein kya hai. Today, if you ask me personally what is there in my portfolio, I will not be able to list out all my stock to you. As I will not be able to list out the number of shares that I am holding in each of those stocks, each of those scripts. And I will not be able to tell you what was their closing prices yesterday, because I am not into that thing at all. So we do research, we do invest, and then of course, general once a week or something, we keep on track on something. If something some development happens, some news happens, then we keep a look at that. Otherwise, they are kept to grow. They will keep on growing. That is the way we manage the stock portfolios. But there are people who are like constant, like 9 o'clock to 3:30 sitting in front of the laptop or computer and glued to the screen. For them, these kind of inputs, they do matter. So that is one thing. And second thing is that sensationalization has become part and parcel of the game for media, and also social media. Because of proliferation of social media, lots and lots of problems have started happening for the mainstream media. And without if you don't sensationalize something, you are not able to attract attention. That has become the problem. So people have been attuned to pay attention only when something is like forced into their eyes, in their face, basically. And that is why all these dramatization and sensationalization of 2 lakh crores of wealth destroyed and things like that has started happening. So that is how it is. And derivatives is, again, normally I will not advise anybody. I will not myself advise anybody to do derivatives. Of course, derivatives is something I personally will do trade in derivatives and things like that. But that is a different thing. I know what is the risk involved. I've gone through lots and lots of like pains and this thing. Spent a lot of time on actually doing research, trying to understand what is when is the time to move out and get out of this thing, book losses and things like that. So it's a very high risk game. Right now, the markets are like going up, up, up. So people are complacent, but when things don't go as planned, if and though if you are like having leveraged position, if and though is futures, basically what you do is you are paying 15%, 20% and taking 100% position. So it's a leveraged position. So your leverage can get you in trouble big time. Any kind of leverage that for that matter. I mean, buying, so investors investing in large number of real estate projects by leveraging, by borrowing is also a big risk because it can create a cash flow, create situations at some point in time. So leveraging and investing is always has got its own risks. And particularly in stock market, unless you have that kind of a dedicated this thing to markets, you should not really do derivatives. And I would ideally suggest that you for 1 year or so have some kind of a guide, some kind of a mentor under whom you take some kind of a training of derivatives, and after that you start doing on your own. So at least 1 year of guidance is necessary to go through, see all kind of situations, multiple kind of situations, and imbibe at least a few basic strategies, some philosophies to apply, to start applying, so that you don't get into a negative zone too quickly, and then you can build upon that. So have some guidance, some mentor, then get into derivatives. Otherwise, don't.
Gopi sir, Yashwant here. I have one question for Ramkrishna sir.
Yeah,
Yeah. Sir, Yashwant here. Good afternoon.
Yeah.
It was very nice session. I have two questions, sir. The first one is related to the topic of capital gains. With my personal experience, I just wanted to bring out this. Now, there is a fund, I think it's called Discovery, which I have invested. And what's happened is basically it looks like a scrupulous practice, which I want you as an expert to sort of comment or guide. The NAV value is eroding. However, every quarter after quarter, they are charging TDS to the members. So when we ask them, they say that the portfolio has gained, but then if the portfolio has gained, why the NAV value is eroding? So that is the fundamental question which we as an investor are unable to understand. And so if you
which fund is it? Can you tell?
I think it's called Discovery by Nuoma or.
Okay, so it's not a mutual fund, right?
They treat it as a mutual fund because the units are there and the unit has got certain value. Quarter by quarter, there is erosion of this. However, every quarter we are being charged TDS, and that TDS also is substantial, a lakh of rupees, lakh and a half every quarter. So when you ask them why is it not reflecting in the NAV value, they say that the portfolio has got enhanced, so they pay the TDS on behalf of the portfolio that is paid by selling the units or something, and then but however the unit value is not. So
no,
I don't
there's
know how to approach the authorities.
something is not adding up. I mean, these things
Exactly.
what you are informing is not adding up. So needs to be explored. See, is this some kind of a TDS hai, ya some they are charging you something?
No, it is TDS because it is going and reflecting in my 26 years as the TDS paid by the. So there is no.
And this is a is this the PMS account that you are having with
PMS
Nuama?
account, yeah.
Okay. So
however, the unit value is eroding. The unit has to actually reflect the value of the gains to pay TDS, but that is not happening, and so that is the dichotomy.
See what can happen. I'm giving a theoretical explanation. I have absolutely no clue of practically what is happening there. But see, when in the PMS, if you are having, let's say 30-40 stocks, let us say 50% of the stocks are below cost, but 50% are above cost. Overall, you are seeing your NAV, which is down by, let's say, 2% of 3%. The fund manager is selling out of your stocks which are in profits, thereby you incurring a capital gain because he is liquidating your profitable positions. So, but because he is liquidating from the profitable positions, your NAV or this thing, your total value of your remaining assets actually would show a decline. in the next period when you will check it. So this way the thing might be happening. So this is something which you have to explore whether this is the situation. I don't have any insight into, so unless I can see the statement, I may not be in a position to really pinpoint exactly, but this can be a plausible this thing, that depending on how much they are selling in your account and what kind of profits they are booking. So the tax incidence will not happen unless there is a profit booking. So going by that logic, essentially.
Yeah,
Sir,
this is
sir,
Dhanshekaran, and
no,
it
no.
was really an
Sir,
excellent
sir,
presentation.
sorry
Hello.
to interrupt. Actually, in the previous case, see, that means really he might be booking a profit. No, NAV might go down, but profit he might be booking actually. Is it so, Mr.
So NAV is calculated based on
Yeah, that is right. That is right. Whether he is booking a profit or not.
So let us say theoretically 15, there are 15 companies where the prices have gone below cost, 15 shares where the prices are still above the cost. So the person is selling from number 16 number company is liquidating. Edelweiss Discovery AIF it is. Okay. AIF is a different thing. So anyway, I'll just continue with this theoretical example which I was saying, but this can be I will have to check this out. So selling
about the statement, sir, and the statement reflects NAV which is eroding quarter after quarter, and 26 years reflects the payment and against those.
Is any payout happening in that?
No payout is happening. No payout is happening. So that was the basic question which we have raised to the fund manager, which he is not able to answer in a very transparent manner. So now we are thinking of approaching the authorities as regards to scrutinize this.
Yeah. No.
So,
I'm surprised why fund manager is not in the position to explain this. But anyway, in case you can, I mean, if it is not too much of a problem, you can share it with on my email. I can just take a look at it and revert back to you on what I think about it. This surely.
sir, another point, the second question which I had, or rather, if you could, currently the Indian market is trading at about P close to 30 as an average. So, and if you see, there is a lot of FII selling which is happening in the background. There are also maybe certain promoters who are sort of selling in the market.
Liquidating,
liquidating. Possibly it is indicating that all these people who have been sitting on huge gains are slowly cutting down on the position at the current market level, which will make the retail investor gullible to be locked in at a higher level, and then market would correct to a significant extent, and then the losses will be all to the portfolio of retail investors who are pouring in money.
So this has been the worry for many people that why does it? So that is why, in fact, I spent a lot of time today explaining what is so good happening about the economy. See, FIS का problem क्या हुआ है? FIS didn't realize the way Indian retail investments. FIS didn't realize, Indians didn't realize. It happened like that. So much of investments would start flowing into equity markets, and they are just self-sustaining and just keep on growing month after month. So that is something which nobody foresaw. Indian markets have traditionally been slightly overpriced compared to any other regional markets because of its own growth dynamics or growth potential per se. So FIIs, when they are looking for their allocation, capital allocation in Asian markets, for example, or emerging markets per se, they will have one particular weightage for India, and then they will also look at like China and South Africa, Turkey, whatever other countries, Korea, they would be looking at. India always being slightly pricey, they would give preference. They will always have other countries' weightages also elevated, and India weightage will always be at a par, or it will be slightly overweight or something at times. In last 2 years, couple of years, so it so happened that the Indian markets have run up so significantly that these people have been waiting for, like, abhi to correction hoga. They have been selling from time to time FIIs. So FIIs at one point in time, I think pre-COVID or this thing, were holding like 20% plus in overall Indian equity, which has now come down to like 17 point something, which I mentioned in the presentation. So 17.1% or something is now. So they have been consistent sellers over a period of in last 5 years. They didn't get a chance to re-enter in Indian markets, really speaking. And in the meantime, China has had a huge meltdown. If you exclude the action that was announced last week of September, or second half of September, basically, when the huge amount of liquidity they have infused. Prior to that, China has underperformed very, very badly, and people, US or whatever foreign investors who have been like, yeah, valuations to cheap valuation ke liye, whatever they have invested in China, they have seen that cheap becoming even cheaper. I mean, the 100 rupee stock going 50 rupees, that is why you are investing, that 50 has become 25. So you have lost another 50% on that. So that is the kind of situation was happening in China. But now it has revised. So I think in between on MSCI index, India had in fact surpassed China. Now I think that will again get corrected. China will again surpass India. So these are the kind of dynamics which will keep on playing out. See, from Indian investors, they don't have any option of investing anywhere else than India. And so these investments will keep on flowing into Indian equity markets only. You, me, anybody else. I mean, very few people who have an option of or investing outside, and whether that is what you say advisable or not, it's again a different thing, because apart from stock market risk, you are also taking exchange rate risk when you are investing outside. And exchange rate risk today, you know that any basically HDFC Bank or whatever, the exchange rate that the differential that they offer is like 4% differential exists on their call and bid rates. So
Right.
if you are investing in overseas markets, you are increasing your risk costs by 4% extra. So unless that market makes 4% extra returns, you are not going to start making. So first 4% returns is basically going to go for the exchange rate, and then after that you're going to start making returns. So that is the kind of problem that exists. So and apart from that, of course, I mean, during the period, if the investment currency depreciates, I mean, if you invest in US dollars, US economy today, US stock market today, and next 3 years, the rupee strengthens against dollar, then in rupee terms, your returns are going to be even lesser. So that differential risk is also you are bearing. So coming back to the point essentially is that Indian markets are going to remain pricey, no doubt about it. All these FIIs and all that, they will some of the other corrections will come. I mean, the corrections is ऐसे तो कभी होता नहीं है, कभी हुआ नहीं है कि correction will never come, not come at all. They will find opportunities and they will invest. Otherwise, right now what is happening is FIIs are majorly investing in IPOs. So IPO is a kind of a safe bait that they are kind of consistently investing. So consistently, you see foreign investors list of this thing in all IPOs that are coming. So they will try to invest pre-IPO at the time of IPO in the QIB, this thing that they will have. These kind of investments or any rights issue that comes up and all that. So you will find all FIIs are essentially very much 100% investing, taking up all those opportunities. So you may find them selling out in the liquid listed markets, But all these unlisted or pre-listing kind of opportunities, they are always there.
Right, sir. So, well, in the outlook wherein the interest rates is being cut by the central banks of most developed countries, indicates the possibility of growth in those markets getting GDP getting going down. So, in order to sustain or maybe improve that, that is the outlook of interest rate cuts from the current levels, and or rather the stability what they are indicating. So, in that situation, basically, it only indicates a deteriorating economic condition globally. Maybe in India, we are seeing or rather being shown a better picture. But the way this systematic investment plan propaganda, which has been run for the last 10 years or so, has created a belief in the minds of common men that equity is better than the FD. It may be appearing for certain phases of the market, but the FDs have a certain sort of perspective, and equity is a different. Now, looks like the amount of cash that is being generated month after month through SIP programs is only to ensure that the FIIs and the bigger institutional investors get a safe exit out of the Indian market, and then the retail marketers get held up at a position which we will only see a deterioration in their market.
One should not. I will differ with this view. See, factually, you can see make out कि okay, 23,500 crores का SIP चल रहा है, and this is like a few years back it was 5,000-6,000 crore. It has gone like 4x, 5x, something like that in less than 6 years, I think. SIP, see, you also need to take into account that in India, beyond like 5 crore people, top 5 crore of the economic ladder people, the rest of the 130 crore people, 135 crore people are not participating in India growth story in any way. If you want to make them participate in this India growth, make the wealth more, evenly spread out, more equitable distribution of wealth you have to achieve, then they have to participate in this growth in some way or the other. The best way is to get them to SIPs and to start them to start investing directly, indirectly in some way or in the equity markets. Only then they will create wealth. Only that will create wealth for them. So SIP it's not a kind of an agenda or a propaganda kind of a thing. So in my opinion, it is a genuine way of ensuring that you maintain discipline, number one. Number two, with equity investments, direct equity investments, what I have seen happening with people start with, let's say, 10 lakh rupees of investments. They will invest, they will take decisions, buy, sell, ye karo, wo karo, ye karenge, wo karenge. After 3 years or 4 years, they will realize that my 10 lakh has become 15 lakhs of whatever, 20 lakhs, whatever the amount has happened. But they will then realize that my 10 lakh initial investment has remained 10 lakh forever. I have not added anything more to it because I was so busy in just taking decisions on what to do, what not to do. I don't want to lose my capital and things like that. So in SIP, what happens is that your capital, the investment itself amount continues to grow and creating a larger pool. So I always give this example that, okay, at some point in time, the market is going to go it's going to double. So before it starts doubling, the huge amount, the larger the pool of number of units that you can have at the beginning will ensure that the commensurate returns you are going to generate at the end. If you are like invested 1 lakh rupees and then it doubles, you just make another 1 lakh rupees. What difference does it make to your life? But if you are made like 25 lakh rupees investment at the beginning, another 25 lakhs, it becoming 25 to 50 makes some meaningful difference to your life. And that is something that is what is achieved by SIP. Not everybody is in a position to bring 5 lakh, 10 lakh, 25 lakhs at one stroke. So they create wealth by this method basically. So boond boond se banta saga sort of situation that you bring small investment every day, every periodically. So that is a very crucial thing for a huge number of people, because as I said, that not everybody can mobilize investments, and it also protects them in terms of volatility. So that is what I like, what you say, rupee cost averaging, as it is called. That is how that is what my view is on this thing. And so the risk that you have been talking about, that at some level वो लोग हम लोग को ये करके they are offloading a high cost thing on us, and we are being kind of mules to carry their burden and things like that. I don't think this kind of victimization, well, you should like victimize yourself with these kind of thoughts essentially. Come on, stock market is a place where everybody is equal. I mean, it's not that tomorrow Warren Buffett comes, so he's going to get Reliance Industries share at 2,000 rupees, and you are going to come, you will get 4,000 rupees. Nothing of that sort is going to happen. It is price is God for everyone. Price is same for everyone. Everybody has to go and make the best of it. So whether you are doing at a like 5 lakh rupees level, somebody is doing 5 lakh when 5,000 crore levels. Essentially, market is going to equalize these opportunities in terms of prices. So
I appreciate this point of view, but my only sort of query was in light of the background that the market is going to double, triple from this level, and the the retail investors will get the bigger opportunity. The more matured player in the market are the FIIs plus the large investors, because they have much more research.
So
and
what will happen is that they will be able to make most of the opportunity. So they will be able to catch more uptrends and exit at the more downtrends and things like that, which is fine. So they might make, let's say, 25% returns annualized. You end up making 18% returns is still good enough. It's not that you have to match them point by point in terms of, because you are not really directly competing with them. You are essentially in riding on the same road. Basically, they are driving a BMW, they will go ahead. You are like traveling in a bus, you will reach later. That is the only thing. It's not a big kind of it's not a big kind of a differentiator in that sense, or in any way unfair thing on any of the this thing. See, when you are looking at a market on a very small time frame, let's say 1 day, 2 day, 1 month, or kind of a thing, market is essentially a zero-sum game. Somebody's loss becomes somebody's profit. I mean, somebody has to make a profit only when somebody else has to make a loss in a very short span of time. But when you are looking at a journey of, let's say, 10 years, 5 years, or 10 years, that is the time when the size of the pie itself keeps on growing. Your corporate profits, they themselves keep on growing. The number of companies in the fray, they themselves keep on growing. So when you're part of that growth journey, then it's okay that somebody little outdoes you or something like that. Both of them can end up being winners. You don't have to be a winner at the expense of somebody else. So that is the perspective one should have when you are doing an investment, and investment is there for a long-term journey. When you are looking at a trader's point of view or a speculator's point of view, who is essentially talking about morning में मैं आज 2 लाख रुपया लगाऊंगा, मेरे को उसका 2,50,000 होके आना है. So you earn 50,000 when somebody else has lost 50,000. So that is that is the game we will end up losing against all these institutional investors. So that is where you will end up losing, in the sense most of the individuals will end up losing against institutions, because they have got better muscle power, and so in terms of research, in terms of technical systems and things like that. So इसलिए, I mean, better not to compete with them in that arena. Be an investor, long-term investor, that creates wealth, and that is a tried and tested thing, sure shot thing, basically.
Thank you, sir. So I'll contact you for the first question which I had raised.
Yes, definitely.
Yeah. Thank you so much.
Definitely.
Thank you, Gopi.
Yeah.
Yeah, it was a very nice presentation. Can you give the prediction for gold?
Gold, as a matter of fact, gold is not something which I really track or recommend for investing. Gold I have always viewed as a unproductive asset. See, gold, why it is started moving is essentially because of problems that are happening, that are building up in the US economy. US economy, as you know, is running high on debt right now. I think every sorry, I forgot the statistics right now. But yeah, so this year, I think their debt uh, servicing uh, debt servicing cost or debt servicing budget is expected to surpass their defense budget. So this is something which is extremely important point, that more money the government will be spending on making good their, I mean, repaying their debts and making their interest payments than on their defense. And that is something which is again has a cascading effect on terms of global peace or something like that. So there is a relationship people have, people are trying to put together essentially. So US's economy is, or government finances per se are in a precarious zone. It is continuously financing it. So its budget is essentially in deep deficit. It is spending much more than it is earning by way of taxes, and it is the differential is being met by issuing bonds consistently. So far as the other governments are maintaining US dollar in their forex reserves, they have to maintain, they have to finance those that spending. So US is in a unique position that they can run, they can get away with this kind of profligacy. No other country can really do anything of that sort. Think of anything of that sort, the currency would go for a toss. But US, again, people are now saying that its luck will probably run out pretty soon, sooner than later. And this is something which has started reflecting in the gold prices now. Gold essentially does not have any specific usage apart from like ornaments or jewelry. Industrial usage is pretty limited. So it's not because some usage is going up, consumption is going up, nothing of that sort. It is essentially any this kind of problems. I mean, in the particularly US economy, if they're having problems, then obviously people will. So historically, just a small anecdote. So when the Second World War happened, and then the new world was like being set up, being thought of, then when the UNO was set up, UN organization, now that became afterwards UN, just UN, then IMF, World Bank, everything was being set up at that point in time. So there was a discussion with regard to what should be the reserve currency for global trade. And US being US, they strategically ensured that everybody accepted US dollar as the preferred currency of trade. So all trade would be routed through US dollars. So even if, let us say, India is dealing with Saudi Arabia, the next door neighbor here, the deals would happen in US dollars. So this is the kind of situation. And then all the countries essentially mandated US, saying, okay, if we will accept this, but then your responsibility is to ensure that dollar retains its value. So there was a agreement that dollar to gold, that peg would be maintained at all times. This, I think 71, the US unilaterally broke. And then after that, the dollar has been has been declining in terms of value. So the dollar declining in value basically means the gold price in terms of dollars is going up substantially. So prior to that, I think some $8 for 1 troy ounce or something like that was the fixed exchange rate for dollar to gold. So that is a brief history of gold and how it gets priced at. But apart from that, I would not hazard a guess on gold. If you are worried, basically invest in gold up to like 5% of your total investments, or maybe little more than that, 5-7%. Investment does not mean jewelry. Always remember that jewelry is essentially consumption of gold. So if you want to invest, you invest. I earlier sovereign gold bonds used to be there. Now this year the government has discontinued that apparently without any official word on it. But otherwise, pure gold, gold ETFs are there, which are traded freely on the exchanges, or otherwise physical gold, which is like certified and tamper-proof packaging and all that, 999 purity, and that kind of gold you can keep as an investment.
So thank you so much. And it was very unusual for a chess player ELO with a high ELO rating to have a very good specialization on this. Thank you. And I should thank the organizers, Mr. Gopi and Vishwanathan, and other organizers for bringing you in. Thank you so much.
Thank you everyone. Thanks for a lively Q&A and nice feedback.
Yeah.
So we'll stay in touch, sir.
Sure.
Thank
Anyone
you.
else? One last question. Anyone else has a question? You may please unmute and ask. One last question.
Sir, I'm Yuvarajan. Sir,
Yeah, Yuvarajan.
I'm very thankful to you. You are making a good presentation. It's a short question. I'm a long-term investor. I have invested huge money, but I'm in good profit ratio. At this moment, there is a prediction that market may fall further. So in this situation, already my portfolio has come down 15%. And fundamentally and technically very strong product I'm holding. In this momentum, can I book some profit time being, and again can I go for reinvestment? I need your valuable suggestion.
Sir, thanks for this question, and I will add. So it is always very difficult to make short-term predictions in the market. So practically, I can give you any suggestion just like that, but that doesn't serve the purpose. The thing is that it is very difficult to predict. You have to understand that. And any prediction that you make and any action you take has almost 50% chance of going wrong. So if you say, I want to hold, I will continue, there is a 50% chance that it will go wrong and the market will correct. And if you today book profits, exit, there's a 50% chance that the market will go up another 10-15% before the correction actually sets in. And it will tire you out saying, I have fear of missing out. What I have done, let me enter back again, and it will wait for your entry for that correction to start. So I always suggest how to think about these questions. First is, do you have any need of funds? Any goal, any immediate goals that you need to meet, something like that. If it is there, then of course, goal linked agar investing rahega, so it always helps our exit decision. It doesn't remain on the market vagaries at all. Second thing is that, let us assume you don't have any specific goal in mind. Let us assume you have a substantial portfolio, as you said, maybe 5 crores of portfolio you're having, and which is having like 3-4 crores of already profit, which is already built up. It makes sense to take some portion out of it just for the sake of peace of mind. And because anyway, you can go right and wrong. So at least like 20%, 30% you take out of this thing. You still remain substantially invested, and you still have some firepower available, like dry powder available, in case the market goes down again. Do not at any point in time exit fully, and this thing you always ensure. Whatever be the market conditions, never exit fully. Be invested at all points of time. So like market situations like March 2020, when the crash happened so savage, in such a savage way. And this is a crash that happened because there were so many short-term investors who had to cash out, who were like, okay, I have profits, whatever, I don't want F&O pay, leveraged positions, and things like that. They are panic situation. You don't know what to do, better sell out and exit. So these kind of situations happened. So people sold heavily and exited. But I mean, those who didn't exit, what happened is within 6 weeks or 8 weeks time, they again come back to the similar kind of costing, and then next 1 year or so actually doubled their money from that point. So it is just like a matter of time before things start correcting again. So again, do not have this fear right now that market is going to go for some kind of a huge crash, and make a judgment with regard to see, one of the things that we always look at is essentially how your day-to-day life is linked to the performance of your portfolio. If it is not really dependent on your portfolio performance, you can wait for a year or two, then you can stay invested. That's absolutely no problem. Going through a dip is not going to be a problem at all.
Thank you so much.
Thanks.
Thank you, Dr. Ramakrishna. What a fantastic session. I'm lost for the right adjective to express how much we enjoyed listening to you today. Thank you for taking your time out on a Sunday morning to be with us, and we'll stay connected. Thank you very much once again.
Definitely, sir.
All the
Definitely.
participants.
Thank you. Have a nice day. Great day. Bye.